Okay, so a very, very warm welcome to your weekend preview with me, Aaron Hill, the Chief Market Analyst here at FP Markets. Last week was dominated by the Fed. The Fed's decision to cut rates by 25 basis points, bringing the target rate to 3.75% to 4%. Now, the cut itself wasn't really surprising. Markets had fully priced this in. But what did catch the market off guard was Fed Chair Powell, his comments during his press conference, which took on a hawkish tone. Now, despite the cut, the vote was unanimous with two dissenters. Unsurprisingly, Fed Governor Stephen Miran voted for a 50 basis point cut, while Kansas City Fed President Jeff Schmidt chose to keep rates steady, a clear sign of the internal division at the Fed. So the central bank had also announced it would wind down its holdings of government debt on the 1st of December. Now, beyond the rate cut, the Fed statement noted that economic activity has been, and I quote, expanding at a moderate pace, while highlighting inflationary pressures along with downside risks to employment, echoing stagflation vibes. This, of course, highlights the tricky situation that the Fed currently faces and foreshadows continued division among policy makers. Powell made it crystal clear that another rate cut in December is not, and I quote, a foregone conclusion. Far from it. This was a significant departure from what markets had been pricing in. If you just take a look at the Fed rate pricing, we are now, money markets are pricing in around 17 basis points of easing. So around a 70% chance of a rate cut in December against a 30% chance of a no change. Now, heading into the meeting, traders fully priced in a December cut. But after Powell's comments, that probability, as you can see, dropped to around 70%, marking a notable hawkish repricing. So the immediate market reaction, as you would expect, saw Treasury yields rally, saw the dollar rally, saw gold and stocks come under pressure. Now, the two-year Treasury yield did jump around 8 basis points, just to note. So while the market has scaled back expectations, many analysts, including really the markets, do still anticipate that the Fed will proceed with the scheduled rate cut in December at the December gathering. However, I feel that this is really predicated on two key developments. The first being a sustained softening in the jobs in the jobs data, especially as we approach the close of the year, as well as the conclusion of the U.S. government shutdown, which is now, I believe, it's entered its fifth week. And given on the back of this government shutdown, sorry, on the with a conclusion to this government shutdown, this would allow the Fed to properly gauge the nation's economic health with the official government data. Therefore, the dollar's recent upside momentum could be short-lived. So adding to the last week's developments, we also saw President Donald Trump and Chinese President Xi agreed to a one-year trade truce at their first face-to-face meeting since I think it was since 6 years. This was their first face-to-face meeting in 6 years. While this certainly reduces tail risks, markets have been relatively muted in response, and because let's be frank, guys, investors have become accustomed to Trump's pattern, if you will, of aggressive initial posturing, followed by more moderate implementation. So that's where we leave the week, and as for the week ahead, I am closely watching a number of key developments. The first being the RBA and the BoE's rate decisions. The RBA is expected to hold steady. The Bank of England's a little bit more divided, if you will. We also have US data out, so US private sector data out. In particular, the ISM data out on Monday and Wednesday. And we also have the ADP employment change data out on Wednesday as well. Now, with the Fed having thrown some uncertainty into December's rate path and the ongoing government shutdown, still delaying that key official data. This week's data, I believe, carries a lot more weight as the Fed and us traders are looking for clues as to whether the cut in December will actually materialize. So, starting today, in a couple of hours, I believe, we do have the US ISM manufacturing PMI out at 3 p.m. I believe most of the focus will be on the prices paid and the employment components. These sub-indices will give us crucial insights into the labor market conditions and inflationary pressures, exactly what the what the Fed is currently trying to balance, their dual mandate. So if we see weakness in the employment component and prices and the prices paid readings, this would bolster the case for a December cut and essentially push back against what Powell's hawkish commentary last week. In that scenario, we can expect downward pressure on in Treasury yields and the dollar, of course, and potentially a bid in gold and stocks. Conversely, if this data comes, this is the manufacturing data and the ISM services print as well, guys. So if we see that data come in robust, so resilient hiring and persistent price pressures, that would reinforce Powell's recent stance and potentially bid the dollar and yields north. So we'd see a further upside in the US dollar. So on Wednesday, again, look, guys, we do have that ISM services PMI print out on Wednesday. That's the 5th of November. Bear with me. I'm just trying to find it here. There we go. The 5th of November. Again, October. This is for the October data, but we also have that ADP employment change data for October out at 1:15 p.m. GMT. Now, the expectation, as you can see here, economists are expecting a moderate gain of 24,000 in October. This is up from the 32,000 decline in September. I mean, look, let's be frank. The ADP data was borderline tier one data before the US government entered its shutdown, and now it's really the only jobs data we're getting, and it's carrying, as I said, it's carrying a lot more weight while the US government is in shutdown. Now, the September, as I just mentioned, the September ADP report was quite weak at 32, a loss showing the US actually cut 32,000 jobs. When estimates actually called for, I think it was around 50,000, a gain of 50,000 jobs. And that, as you can imagine, represented a significant miss and suggested hiring momentum was indeed slowing in the US. Now, if we see another weak print this week, it will add to concerns that the labour market is softening and increase the pressure on the Fed to proceed with that December cut and essentially go against Powell's comments. Now, a stronger print, on the other hand, will likely have the opposite effects. Now, we do have a number of Fed speakers out this week as well, which I feel will be just as important as the US data. Given the divisions we are seeing within the Fed. And let's not forget, Powell actually said that there is significant dissension within the committee. Now, if the majority of the speakers, of the Fed speakers lean towards a dovish stance, suggesting that they support December's rate cut, despite Powell's caution, if you will, we could see a reversal of last week's hawkish repricing, and this could mean dollar weakness and lower yields. But if most of the speakers echo Powell's cautious stance and lean more hawkish or even more hawkish than Powell, this could trigger a further upside in the dollar and yields and continue to pressure risk assets lower. In terms of the we have two central bank announcements this week. We have the RBA, as I've mentioned, and the BoE, the Bank of England. So Tuesday, the 4th of November, so tomorrow, the RBA is scheduled to announce a rate decision. Now, the meeting is shaping up to be a very straightforward one in terms of the actual decision. As you can see here, money markets are pricing in 95% probability of a no change decision against a 5% chance of a 25 basis point cut. I don't think it's so much the interest rate decision that's going to be the focus here. I think it's more regarding the statement and the tone that will be critical for the Aussie dollar. Now, it is widely expected, as I said, for the RBA to remain unchanged at 3.6%. Particularly, I mean, this is largely due to the recent inflation data pouring cold water on any near-term easing. I mean, as you can see here, we have less than 2 basis points of easing priced in for the upcoming meeting, and not much is expected to happen, as you can see on the curve there, until later in 2026. Now, all economists polled by Reuters are also calling for a hold decision. Despite jobs numbers coming in soft and unemployment rising, which essentially bolsters the case for further easing. I mean, unemployment came in at 4.5%. Look, all key inflation, and despite the unemployment, despite the soft jobs market, all of those key inflation measures for September, I think it was. Bear with me, guys. For September, actually came in higher than expected, and this includes the Q3 year-over-year Aussie numbers, with inflation rising to, I think it was 3.5%. Up from 2.1% in the previous quarter. And look, guys, the RBA works with an inflation target band between 1 to 3%. So the Q3 year-over-year print is now 0.5 percentage point above that band. And the trimmed mean for the same quarter year over year, it actually rose to 3%, which touches the upper boundary of that of the RBA's inflation target band, and this was up from 2.7%. So I also want to add that the RBA faces challenges from surging housing prices as well. So cutting rates could really add fuel to the fire regarding this, and this really argues strongly against a near-term rate cut at this point. So with the rate cut off the table, language will be key. Should the RBA lean more dovish in its communication, think of something like highlighting the softness in the jobs data. The Aussie dollar could trade lower on the back of that, while any hawkish commentary that pushes back against those cuts in later in the year here, then this could strengthen the Aussie dollar. In addition to the RBA, we also have the Bank of England out on Thursday, and that is the 6th of November, I believe. Bear with me, guys. Sorry about this. It should be... There we go. So yes, the Bank of England is out at midday local time, which is UK, so that's GMT right now. Look, money markets are implying let me just pull up the interest rate probabilities here. So the Bank of England money market expectation, 65%. So a 65% chance of a no change decision versus a 35% chance of a 25 basis point rate cut. We have around 9 basis points of easing priced in for this meeting, with around 16 basis points priced in for the December meeting. So there's a strong possibility that we may not even get any cuts for the remainder of this year. As you can see, 32 basis points is priced in for February's meeting. As for this week's meeting, 54 out of 65 economists polled by Reuters are calling for a no change decision. And they are expecting this in the form via a 6-3 vote cut. And this is versus the 7-2 vote split. Excuse me, the 6-3 vote split versus the 7-2 vote split in at the previous meeting. So despite the softening jobs data and weaker than expected inflation data that we recently had, we have to account for the fact that price pressures are still nearly double the Bank of England's inflation target of 2%. I mean, September CPI inflation actually came in at 3.8%, unchanged. But the services inflation is a touch more concerning at 4.7%. Look, these levels are just I think they're just too elevated to be for the Bank of England to be considering cutting at this point. And this, coupled with the uncertainty of the surrounding the autumn budget on the 26th of November, really means that the BoE is unlikely to move at this this week. This is why I'm a little surprised to see. 35% chance of a rate cut, given all of the headwinds for the Bank of England right now. So should the central bank indeed push that pause button, a short-term push higher in the pound could be seen, while a 25 basis point rate cut, of course, would weigh considerably on the currency, I believe. As usual, the vote split will be key to watch. As I've mentioned, 6-3, there is a 6-3 vote split that economists are calling for, versus that 7-2 vote split in the previous meeting. Now, this is really where it gets interesting for me. That 35% probability of a cut that markets are currently pricing in, again, it just feels too high for me, given the elevated inflation and the uncertainty regarding the autumn budget. Now, I think these cuts are being priced in due to the weakness in both growth and the jobs data, and one could argue that cuts are needed regardless of what happens in the autumn budget. While I feel it's unlikely, a surprise 25 basis point cut isn't off the table if you go by market pricing. And I mean, if this happens, without it being fully priced in, that we would see immediate downside in the pound, I believe. Now, if the BoE follows through with a hold, as 65% is priced in, 65% probability, when the markets are pricing in 35%, a 35% chance of a cut, we could still see some short-term covering on the back of this, sending the pound higher. If we do get a hold, the immediate focus will then also turn to the MPC vote split. How many members voted for a cut versus a hold? So, as I said, economists are expecting a 6-3 vote in favour of a hold. If this is more close, like a 5-4 vote, again, so 4 members vote for a cut, while 5 opt for a hold, we could see the pound bid, as this will likely be viewed as more. We could see the pound sell off, as this will be viewed as more dovish, while a 7-2 vote, or even something like an 8-1 vote, will be seen as hawkish, and likely boost demand for the pound. So together with the decision and the MPC vote split, we'll also receive the updated economic quarterly projections. Look, the consensus view is that the central bank will largely align with the previous NPR estimates, but any meaningful changes to growth or inflation forecasts, really could move the markets. So to wrap up the week ahead, the Fed's hawkish surprise has really has placed a rather strong spotlight, a rather bright spotlight, I should say, on the upcoming US data and, of course, those Fed speakers. And every comment, I believe, will be scrutinized for clues about whether the December cut will actually happen. With the government still in shutdown, still preventing official data releases, the ISM surveys and that ADP employment report will take on outsized importance, I believe. Weakness, as I said, look, guys, weakness in these reports would support the case for December easing, while strength would support or validate Powell's caution, if you will, and bolster demand for the US dollar. We have the RBA on Tuesday. Pretty much a straightforward decision in terms of the rate hold, but the statement tone will matter for the Aussie dollar. So do be on the lookout for any hawkish or dovish signals in the tone of the statement. The Bank of England, again, is out on Thursday and is expected to hold with a 35% chance uh, um, priced in for a cut, with a 65% chance for a hold. The vote split will be crucial, as I said, um, and will be something you want to keep an eye on during the event. Also, just to reiterate, keep an eye on those Fed speakers throughout the week. Their comments, their suggestions could provide the cleanest signals about a December rate cut. That's it for the the week's preview and the week ahead. Have a fantastic trading week ahead, and I'll catch you next week. Thank you very much.